Hey there, folks. This is Mark from Maple Capital Partners. And in this month's video, we're going to be talking about how our underwriting is changing in response to market changes going on. And I'm sure for anybody that's been following any kind of national news, it's no surprise that there's a lot of talk, there's a lot of chatter about real estate changing and really heading into a period of uncertainty as interest rates have changed. So we're going to talk about how we're adapting our business to that and how we're continuing to look at deals and underwrite deals in response to that. One of the things that we have always been keen on is looking at what the best do in our industry and trying to follow the clues, follow what they're doing. And what we can say without a doubt is that the best investors in any asset class, they don't try to time the market. They're not in and out. I mean, Warren Buffett, arguably the best investor of all time, the most decorated of all time, is the first to say that you can't beat the market. You can't time the market. Well, one thing's for sure, what some of the best investors do is they adapt with the market. So they find ways to be profitable in up markets, down markets, and sideways markets. And we're going to go through some of the ways that we have adapted our underwriting to the changes in the market itself. So first of all, it's financing. Financing, when we're underwriting, is a really pivotal part of the any model. And really, the leverage and loan terms and rates that you have can determine what you're willing to pay for a specific property. Now, in the last 6 to 8 months, really, the Fed has been hiking rates, and that's had a pretty adverse impact on a lot of the deals that we tend to look at. Rates in the beginning of this year were anywhere in the 2 to 3 handle range. That is, the rates had a 2 or 3% figure on them. However, today, the cost of capital, the rate at which you're able to finance these deals is really probably double that, 5, 6, 7% in order to finance the value add deals that we're looking at. Now, this increase in cost of capital, of course, has a drastic effect. As I said, it drags on your returns and what you're willing to pay for properties. So it's really important that you underwrite as such. Not realistic if you're underwriting deals at a 3% interest rate if prevailing rates are in the 5 or 6 range. Next on the financing side is the refinance assumption. Now, we are and have never been ones to underwrite with a refinance assumption built in. That is, we never build into our model the assumption that we're going to refinance in 2, 3, 4 years. We've seen a ton of other operators out there that do this, and we always have a little bit of trouble with that because when you underwrite and include a refinance in your analysis, you're making a whole host of other assumptions there that you really don't have any kind of control over. You have to know what capital markets are going to look like 2, 3, 4 years down the road. And if this last 6 to 8 months proves anything to us, it's the fact that capital markets are constantly changing. So instead of assuming the refi, what we will consistently do is we'll try to match our hold period with the loan term. If our loan term is 5 years, we have 5-year debt. That is, in 5 years, there's going to be a balloon. We'll assume the deal is going to be a 5-year hold. And in 5 years, we'll sell the property. Now, if we have the opportunity to refi in the meantime, year 3, 4, or so on, and return some capital to us and our investors, then great. That's the cherry on top. But we never go in with that assumption in mind because it can end up being an unrealistic assumption. And if a lot of your returns are premised on a refi, when you're not able to do it, either rates back up or leverage changes, or maybe you're not able to execute on the business plan, then, that can really end up depressing your returns. We've always been ones that want to underpromise and overdeliver for our investors. The next assumption that we're tweaking in light of the changes in the market is the vacancy rate. So we're heading into a period, a lot of people are using the R word, recession. They're saying that, this is going to be a really rocky and could be a hard landing here as the Fed is trying to engineer a slowdown and really temper down inflation. And so a lot of people think that that'll mean a widespread economic recession. And obviously that would have a huge impact on vacancy rates as people maybe, lose their jobs. They're now not able to afford their rent. Maybe they move back in with family. And, that's why you tend to see during recessions, vacancy rates do expand. They do grow. And I'm not just talking about physical vacancy, by the way. I'm talking about economic vacancy. So physical vacancy, we've touched upon in prior videos, is how many units, what percentage of units do you actually have people physically in? Whereas economic vacancy is, the percentage of units that are rented that are actually paying. So, during a downturn, typically what you'll see is you'll see a lot more economic vacancy. That is, people will fall behind on their rent. There will be, collections issues. There could be, depending on the tenant demographic and situation in your market, and there may be a lot of bad debt. And so we're preparing for that possibility by increasing our vacancy rates. One of the things that we've just lived through these last 2 years has been an unprecedented low vacancy rate, pretty much historically, since I've been investing, and really for the last 30 years, this is the lowest vacancy rate we've had. So we're trying to get ahead of the possibility that there could be a decompression, that is a growth in the vacancy rates, should we encounter some economic turmoil here in the next few months. The next assumption that we're changing is rent growth. So typically, we'll look at rent growth in our market historically, and we'll use that along with what we think supply and demand is going to do to come up with an assumption around rent growth. Now, if you were to just look at historically for the last 2 years, what rent growth has done in many markets, it's upwards of 20% year over year. I know in our local market in New York City here, some people who were releasing or finding new leases, they were really surprised to see their rent rates go up 25% in just the last year. Now, I think any rational person would think that that's not sustainable. And so in all of our assumptions, all of our underwriting, we're assuming that in the out years, we're going to have lower rent growth. So much more in line with historical averages in our markets rather than the last 2-period average that we've seen here. So that's one thing that you definitely want to be careful of, because so much of the return of a particular deal that you're underwriting, that you're analyzing, is built upon that top line, that rent growth figure. So if you're not able to achieve that, that's going to throw off everything else throughout your underwriting. And that's why you want to be super conservative with that number. So the fourth assumption that we're tweaking in light of the market changes here is expense inflation. So along with rent growth, we also have to factor in expense growth. And for anybody who's been following the news in the last 6 to 8 months, inflation is on the tip of everybody's tongues. And so inflation, has been historically high in the last 6 to 8 months here, as the Fed and Congress has really let the spigots of easy money flow over the last couple of years. And so that's caused a lot of inflation really across the board here. And we as owner-operators of multifamily properties have definitely seen that in the cost of hiring and labor and also materials as well. So we are underwriting to a prolonged period of higher than historical average inflation. Historically, you could say between 2 and 2.5% inflation was the norm. But nowadays, core inflation is running around 6 to 7% in the last few months here. So we're projecting forward in out years that it's going to be higher, somewhere in between that 2 to 6% range, and that inflation is effectively anchored in consumer minds, and so it's going to stay stubbornly high. That's what we're projecting for. One of the other things that inflation impacts is your insurance rates as well as taxes. Now, insurance rates and taxes as well usually have a lag, so that means that insurance is not going to really reset. It doesn't reset every month. It's really whenever you take out a new policy, whenever you renew your policy, that you see an increase in insurance. Now, it stands to reason that if labor and materials costs are going up, then your insurance, the cost to protect your property and your assets will go up as well. And the same is true for taxes. A lot of people have been really surprised by the growth in the value of their properties, but what they don't realize is that a lot of municipalities finance themselves, as well as states finance themselves through the assessed values of those properties. So, you can be happy for your property values going up, but you better believe that, when it comes time to reassess, you're going to have to pay the piper in the form of higher taxes to your city, county, or state. And so that's one thing that we're definitely building into our assumptions as we underwrite deals. The next assumption that we're changing is our higher reserves that we're carrying. So we mentioned potential for recession in the next 6 to 12 months. We think that it's only prudent as an investor and a steward of others' capital that we carry higher than usual reserves. So what do I mean by reserves? These are really rainy day funds that we carry on the sideline of all of our deals, just in case, something goes wrong with the property, in case market turns. It's really, money that you want to have that helps you sleep easy at night and hopefully helps protect and preserve the capital that you and your investors have in deals. And so we usually try to keep anywhere from 4 to 6 months of operating expenses on the side, just sitting in a checking account or savings account, just should we need it. Now, today, that number looks a lot closer to 6 to 9 months of operating expenses for our reserve that we're looking at deals with. So that means that we'll be able to go, if we never collect another dime in a particular property, we'll be able to go 6 to 9 months of operating that property before we got to make a decision. And so while the investor side of my mind says, okay, having that much cash is a drag on returns because it's just sitting there unproductive, that's absolutely true. But we consider it absolutely worth it if it's a matter of keeping the asset or not. So we're increasing the amount of reserves so that we are ready and prepared should markets deteriorate here and we experience, a little bit of turmoil in the multifamily space. And the last few items that we have in terms of changing our underwriting are longer hold periods that we're assuming, as well as lower return expectations. So along with a higher cost of capital, a particular deal at the same purchase price is not going to look as attractive. You're not going to be able to, with a higher basically financing rate, lower leverage, and so on, you're not going to be able to return as much, whether you're talking cash on cash, IRR, any of the return metrics to your investors as you would have at a lower rate. So the same deal today looks worse off than it did maybe 6 to 9 months ago. And so it's only right that we have to adapt to changing circumstances. And so whereas, and before, if we were aiming for a mid to high teens IRR on our deals, internal rate of return, then today maybe we're a couple percent lower than that, just for the fact that we have all of these other dynamics at play here. And also longer hold periods. So we're kind of de-risking in terms of the types of deals that we're looking at. We're definitely not looking for home runs. We're looking for solid value add business plans and deals where we can go in and immediately improve value without necessarily having to rely upon the market to appreciate in order for us to do so. And so a lot of the deals that we're looking at, they're not relying on a 1, 2, 3 year time frame in terms of achieving our business plan. It's really a 5 to 7 year hold. And why that gives us a lot of flexibility is that if we're saying that we don't have to, knock it out of the park in the first 2 years, that means that it doesn't matter to us where the market is 2 years from now. We basically have 5+ years to identify an opportune time to sell. And what that allows us to do is we can wait out different turns in the market. If conditions deteriorate, we can hold on to the property longer. We can refi out and hold, well beyond that, 1, 2, 3 year time frame to a more opportune time to sell. And we think that that's a really prudent approach given what's going on in the capital markets today. So with that, these have been our top changes that we've made to our underwriting and how we're adapting our analysis of deals to current market conditions. Again, just to go through this really quickly, we talked about financing and our cost of capital and kind of the rates and terms on financing, how that's changed. We've talked about vacancy rates, our rent growth assumptions, our expense growth assumptions, the fact that we're reserving higher on our deals, and that we're assuming that we're going to hold a lot of these deals a lot longer, and we have lower return expectations for us and our investors. Hope this has been helpful. If you have any questions about underwriting, feel free to reach out to me at mark@investwithmaple.com. And as we say here at Maple Capital Partners, be kind, be charitable, and invest wisely. Thanks, folks.